Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from SHF Holdings, Inc., doing business as Safe Harbor Financial. Please note you could submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Sunday Seafried, CEO of SHF Holdings, Inc., doing business as Safe Harbor Financial, which trades on NASDAQ under the symbol SHFS. Welcome, Sunday.
Thank you. It's good to be here. Okay, I'm sorry I'm not on video today, but we seem to have some video issues and a snowstorm in Denver, so it could be the problem. Anyhow, I want to open just with a cautionary message that I am not able to talk about certain things because we're in the process of filing our 10Q, and so some questions I may not be able to answer until we have our earnings call and get the 10K filed. So I will stick with what's been approved stuff. So Safe Harbor is a fintech platform, and we are now in our 10th year actually of facilitating traditional banking services and lending services to the cannabis industry. And we utilize financial institutions and their balance sheets. So we are not a REIT or an equity fund. We are simply working with financial institutions to provide traditional banking services. We are, experts in terms of cannabis banking. We entered the business in 2015, and the entire management team together and officer team have over 50 years of experience in dealing with cannabis businesses, whether it's with lending, merger and acquisition, account transactions, etc. So we have a strong management team, and we have 41 states in which we are now facilitating cash transactions across the country. This actually came about as we were under Partner Colorado Credit Union originally, and our clients were moving throughout the country, and the platform just ended up building itself, and I'll talk a little bit more about that in a minute. And we have opportunities since we've gone public and we've decoupled out of Partner Colorado Credit Union to actually grow on bigger balance sheets, utilizing mergers and acquisitions and other financial institutions other than our original parent company. The industry, as far as cannabis goes, is huge at this point in time, and because banking isn't readily available to the industry, we feel we have a stronghold in the market. So if you look at this, 74% of Americans now live in a state where cannabis is legal. It's strong support for legalization. The projected market is going to reach, or expected to reach, $56.9 billion in 2028. So you can see some significant growth projections. And this has much to do with the fact that legalization has been rapidly occurring since COVID. And a lot of the states who are legal at this point in time haven't necessarily enacted a program to the fullest extent. So there's a lot of growth opportunities still coming. We have 38 states are medically approved, 24 states that are adult use, and this is where most of the states start with a medical program. They start to realize some of the tax dollars, and then they turn to an adult use. And then, of course, 16 states are proposing legislation. Okay. I want to make sure I'm coming across clearly here. We made an adjustment. All right, so let's move to the next slide. Why is it we have an advantage in doing this? And the fact of the matter is, not a lot of financial institutions will actually move into banking cannabis because of the federal illegality of cannabis. And that means that financial institutions, directors, and officers can actually be prosecuted just for serving the industry. And that's one thing that's keeping a lot of the financial institutions out of it at this point in time. Safer Banking Act will take that particular risk away, but it will not take some of the other barriers away. The biggest barrier to entry that I consider would be bank secrecy, which has been around for decades, and the fear of being fined for not doing it. It's high compliance costs, but you can also be fined banking a high-risk market like cannabis. It's high risk because it's like a money service business, and it is cash intensive. You can think of it in terms of banking casinos or check cashing or even liquor stores and grocery stores, a lot of cash and a lot of gray market behind it. And of course, we know that in the cannabis industry, there is a lot of black market activity still operating in plain sight, and especially in some particular states who have been allowing it to operate publicly. So those are the biggest concerns about banks. We're not allowed to let one illicit dollar move into the system. And that's bank secrecy. That's not cannabis at a legal level. That's not safer banking. This is bank secrecy that won't go away no matter what else happens. And of course, the lack of standards. We did a lot to improve the standards across the country in terms of going through and enduring 16 federal and state examinations while we were under the credit union, which helped us fine-tune it and build our confidence with the regulators. But that takes a lot of effort and time to set up a program. This is a picture of what we actually do. So if you look at the blue here, this is what Safe Harbor is. It is the fintech platform and the compliance platform that sits between the financial system, which is banks and credit unions, and the cannabis companies. What banks don't want to do is bank cannabis because there's a reputation risk, there's a compliance risk, but they do want to participate in the market. So what they see is us in the middle of that. We actually deal with all the service-related issues with cannabis businesses. We start by onboarding them and collecting onboarding fees, and then we put them into the platform, and they can issue commands in this platform to move their money across the country. And this platform then goes and speaks to the financial system and the banks and actually executes on those transactions. So the bank still remains the money transmitter. We are the facilitator of services. We have fee share agreements with the banks and credit unions with whom we do business based upon earnings in the fintech platform. When regulators come in, it looks like the financial institution is banking Safe Harbor, who's actually banking the cannabis businesses. So it seems like it's one step removed from the rest of their actual customers and not mixed into the organization. And then, of course, we earn our money on monthly compliance fees, which are about $700 per month per account. And that's because we have to validate and monitor these companies at a very high level, enhanced due diligence as required by FinCEN and regulations. And we make depository fees and transaction fees, anything from ACH fees for originating and wire fees and normal banking fees. And of course, we have investment income based upon our deposits at any given time. We keep them pretty liquid. So if they're in the Federal Reserve, which is where most of them are, they're earning up to 5% or whatever the Federal Reserve's overnight funds are. And then we earn loan income based upon loans that we originate. And I will show you what that looks like year over year because it's one of the numbers I was allowed to release today. And again, we fee share back with the bank as a fintech model. So revenue growth and performance. Last year was a difficult year because we had just gotten out of de-SPAC, but you can see in 2022 and 2023, we have been able to produce an 85% increase in our revenue, despite a lot of the roadblocks that we had in terms of de-SPACing. And that's a good sign there. And then what you're seeing over here is quarterly revenue stabilizing, which was important to us in the last year to make sure that we were stabilizing our income and of course, being able to grow it as we go forward. If you take a look at the source of income and the composition, this is important to us because we built this model actually dependent upon deposit activity fees. We weren't lending. So lending was a new service that we really went forward with in late 22 and 23. And then, of course, the investment income, which is what we're earning on our deposits, and then some licensing fees, which is an old model where we actually help put other financial institutions and allowed them to use their IP. So in 2022, you can see the depository fees was a big part of our income, but not something we wanted to be dependent upon. In 2023, you can see that is shrinking down to 49%. Loan income is up substantially, and you'll see that in another slide. But of course, because of the rising rates, we're not only seeing better interest rates on our deposit income, which is up to 33% of total income, we are also seeing loan income in, and it just isn't showing exactly the impact here. We do want to not depend upon just depository fees because of competitive pressures that might come down the road. We want to make sure that we are earning income in other areas and compensating for the pressure on that pricing. Interest income and credit growth. So credit growth was a main focus for us in 2023. And you can see quarter over quarter we increased our credit, and the impact on income was substantial. Now, even at the year end, this does not reflect interest that we earned on a $9 million loan that we put out at the very end of December. So, we should expect to see this continue to grow as a percentage of income in 2024 and continue to grow our loan portfolio. We focus mostly on real estate loans, secure loans, 65% loan to value type loans. We have to loan like a bank would loan. So our loans are conservatively underwritten, similar to a bank, because the bank has to be comfortable enough to house these loans on their balance sheet. So loan income is a very important growth area for us. All right, so scaling revenue, though. We have present revenue streams, as we've talked about it. Investment, income on deposits, lending fees. We do origination, which is 1.5% of the actual loan. We target loans actually between $4 million and $10 million at this point in time. Then loan interest income. You'll see that we're putting loan interest rates out there between 10 and 15%, depending on the risk associated with those loans. And of course, loan servicing fees are part of that interest that we're earning there. We have the compliance and onboarding fees and deposit activity, transaction fees. Third-party processing is a good business for us. The problem with it at this point in time is you can't get into the major credit cards. So transaction fees are a lot of ACH transactions that we do, and we bank or facilitate banking for third-party payment processors, and they fee share back with Safe Harbor on a per transaction level. So that's a good income for us as well. And then program licensing. We don't license our program out regularly, but if there is a market in which we do not want to do business, we will consider actually putting up a financial institution on the program, sharing our IP and our software, and then they fee share back with us. Future opportunities includes more loan options. We just launched a robust line of credit option for our clients, which is a sticky product for them for long term, and it also is a good product for us on a higher interest rate level. Loan participation fees. We sometimes have loan requests come in for $30 million or $40 million, and no one financial institution wants to take all that risk, so we're facilitating this year participations within our network of financial institutions who are friendly to cannabis businesses. And of course, underwriting for third parties. We have people who don't understand the cannabis industry or financial institutions coming to us, and they don't necessarily want to do the underwriting because they don't understand the credit risk and the composition of these companies, so we can do that for them. Direct payment processing. The more we can get into the payment processing, the better the income comes, the lower and more competitive we can be on other relationship pricing to include depository services. Insurance products, any of these things that they have a difficult time getting in the cannabis industry, we're trying to move into, and direct vaulting and courier services. We are on any given day of the week, calendar day of the month, we are moving $7 to $10 million around the country utilizing different courier services. So different options are out there for us. This gives you an idea of the footprint that I had discussed earlier, which was that we have built a national network. So how do we do this? We've taken cash from all those states where you see where the numbers are in those boxes, and we have Federal Reserve accounts across the country. So all those orange dots represent where we have accounts at the Federal Reserve. our couriers in those states that we have selected, because the major couriers haven't been able to do this across the country. They've been cannabis shy in terms of mixing cannabis dollars with normal financial institution dollars. But you can see that we have set up a system where they can pick up the money, they vault it, they count it, they send us a report each night, and we credit that account in one location. So we're getting reports each night, and our clients are getting credits to their account each night. And then once they get the credit, of course, our money then moves to the Federal Reserve and is put into an account for the financial institution in which we're actually facilitating the transaction. So we built this platform over the last 9 years, and we're able to do this while we were even under Partner Colorado Credit Union. We now have the model that will allow us to continue to do it and actually grow without having to build it out. So our competitive advantages would include, consistent performance. You see a lot of financial institutions who actually get into the banking arena for cannabis, but then they leave it because they don't realize how compliance heavy this is and the cost of compliance. And so a lot of times, though, we're actually seeing financial institutions who are coming to us and saying, we need to gracefully exit at this point in time. We don't really want to do this. It's taking up too much of our time. That's one of the reasons we actually decoupled this from Partner Colorado Credit Union, was because strategically it was taking up too much of the credit union's time and balance sheet, and they really need to do what they did best, which is serve their members. So having this segmented out has been a good thing for us. The lending and depository services, there are some quasi-competitors out there who actually consider themselves competitors, but they don't do both sides of the balance sheet. They will do depository services, but not necessarily lending services. We have a low cost of funds advantage. We don't have to go to the market and then return 6-7% to any investors. We actually work with the financial institution at a reasonable rate, and then we can mark that up and make the difference there. We have the cannabis expertise on the management team, as I've talked to you about. Brand recognition, because Safe Harbor was actually created in 2015 and was a front runner. We took advantage of that growth and kept moving and growing with the market and became a well-known brand. We have proprietary software. Both our fintech platform and our compliance software is fully owned by us and has been developed from the bottom up, from the banker perspective up, right from the start all the way through. So we're not dependent upon anybody else to launch this across the country. The barriers to entry that we talked about earlier is a competitive advantage to us. The longer they're afraid to move into it, the more we can grow and get ahead and remain ahead of the market. And regulator acceptance. They have built their confidence in Safe Harbor because they have examined at the federal and state level 16 times. And, while it was a very difficult process to go through those examinations for my team, the fact is we really refined all of our BSA activities for cannabis to satisfy regulators. So we have that reputation. And then we have multiple growth opportunities. Talking about growth opportunities, our strategy at this point in time, we have organic growth. What we're seeing now is a lot of consolidation in the market. So we are trying to retain as those companies consolidate or even as their businesses consolidate. So organically, we are focused on balanced growth and account growth from in-house referrals, from growth of our companies. And then, of course, we have the ability to acquire. This is a major strategy for us in 2024. Those financial institutions who are coming to us at this point in time who want to exit the business, we want to find a way to move their portfolio to Safe Harbor, whether it's we retain a relationship with that financial institution and move the business to us, or whether we move those accounts into one of our financial institutions. So this is a major opportunity for us to pick up 500 or 600 accounts at a time and have a larger share of the industry. Then, of course, we have new commercial lending opportunity. Providing that access to capital is a really good thing, especially as we're going after the larger companies and multi-state operators out there. We can actually lead with lending as an opportunity because they're not just getting that access to capital. So we also are considering the legalizing markets. As we said, there's ballots out there on 16 different states. So all of those, considering that we're in there educating in advance legislators and regulators and making sure they're comfortable with safe harbor, and then we get to the market. We're also in the current legal markets that are growing, and then, of course, M&A. So when we talk about mergers and acquisitions, we're really looking to find complementary services if we were to go into insurance or something like that. So, but right now I would say the bulk acquisition of clients is one of our fastest way to increase our market share. Commercial lending, our advantages here, we talked a little bit about this. We have lower cost of funds because we are utilizing our deposit base. We make arrangements with our financial institution that actually allows us to loan off our deposits, which is a much lower cost of funds than going out to the market, as I said earlier. We also know our customer. We have hundreds and hundreds of accounts on which we can actually loan. We monitor those accounts on a monthly basis. We actually know their cash flow. We know their officers. We know their business. We have a private banking model, so they know their banker, and our bankers aren't private bankers because they are providing great service, which they are. They're private bankers because they have to know their customer and know this business. And of course, we have conservative lending standards, which we are going to maintain, especially in our first couple of years of building the portfolio so that we have a nice solid. There are opportunities across the country that we are taking advantage of because they have paid cash for their buildings, and now they weren't able to get any kind of access to capital, and now they want to take the cash out. So we have the ability to help fund these on some solid operations with present cash flow. This just kind of shows the long history. One of the things I like to point out on here, and I won't go through every year, every year of work, but what we did was very transparent from the very beginning. We pretty much put it out there and told the regulators and all the federal agencies, if you don't want the money bank, then you can take us out of this earlier, sooner than later, so that we won't be getting into the market, getting out of the market. But we established relationships with the Federal Reserve, with the attorneys generals. We made sure that we were out there very transparent and actually educating everybody we could to bring them along to be able to provide banking services. Okay, our management team, as I said, lots of experience here. People have been dealing with cannabis companies since 2014 or 13, 2009. You can see there's just a lot of cannabis experience in understanding the industry. So at this point in time, I think I'd like to open it up for questions if we have some. So let me take a look. Oh boy. We have two glasses on here. Okay. Okay, first question. Where do you expect your geographic growth to be strongest in 2024? Also, is Missouri and Arkansas your largest markets today? No. Okay, I'll answer that part first. Missouri and Arkansas are not. Actually, Colorado is where we actually started out our business. So Colorado is probably our strongest market. Missouri and Arkansas are probably our second strongest market, and that's because we acquired Abaca, who was also a competitor, quasi-competitor, only did depository services in Missouri and Arkansas, so we picked up their market as well. And our strongest geographical growth, I would say it's not necessarily geographical. I think one of our biggest business development activities is actually going for the multi-state operators. We were unable to do those before simply because we didn't have the balance sheet access that we now have at this point in time. All right, let's see. Are there any upcoming regulatory catalysts for your business? I think that's a great question, and one of the greatest things that we're looking forward to is the potential rescheduling. First of all, the Safer Banking Act is a good thing because it will remove some of the barriers we have to banking at this point in time and the fear even from our present partners because of the the fear of prosecution, but also the fear of being excluded from the Federal Reserve, or, those threats exist. So SAFER is good for the financial institutions. The other thing on rescheduling is it goes to a reschedule of a 3 in this next year, which is, I'm hopeful. I don't know, it's a very difficult thing, but if they go to a Schedule 3, it takes a tax burden off the back of our companies, which allows them to have an immediate cash flow increase, because sometimes they are effectively taxed at 70 or 80%, and taking it to a Schedule 3 will remove IRS 280E from them, which does not allow them to take normal business deductions other than cost of goods. So immediate cash flow increase, but then it also will probably attract more investment funds into the industry because it's going down in terms of scheduling. Oh, the compliance fees would be what I pointed out on that first page, where it has moved down to 46%, that we're continuing to push down compliance fees, where it used to be when we first started was up in 87-88%. So the percent of our revenue comprised of compliance fees is decreasing purposely as a strategy. It's being replaced with lending fees, investment income, and actually payment options. So we can put ATMs out there and collect on per ATM transactions in all of our dispensaries. So those are some key areas that we're picking up. Let's see. The loan book has grown over $40 million in this year. How much do you project it will grow in the next year? Well, I would say that we have projections, but there are different ways that we're actually making loans with our financial institutions. So that's one thing that you have to understand. We are definitely projecting more than $40 million there this year, but some of the financial institutions with whom we want to do business may want to increase their loan book, say $100 million, hopefully not all in 1 year, but we would sit in the middle of doing that, underwriting, servicing, and providing those options to the financial institution who wants to book them all on their own, only as a loan partner. And that would be totally 100% their risk, but we would get the servicing and the origination fees and a percentage of the interest of those loans they hold on their books. So that's one way of doing it, not necessarily going to show in our book of business. Then we're also looking at the ability to get lines of credit based upon balances at other financial institutions, which would allow us to make it and book it right on our own balance sheet. And then, of course, we do the way that we're doing it now. We put the loans on the books, we take last dollar loss, and we have full responsibility for those loans with our financial institutions, but we also earn lion's share of income because we are doing it. Let's see. With a 1.5% origination fee on the loans and net yield after the revenue share of roughly 10% net interest. Yes, shareholders would love to see it multiply significantly. Yes, and I have to say, though, that some of these contracts were cut in low-rate environments, so they may not go on forever. But here's the good news: with interest rates rising, we were originally, based upon that particular contract with that financial institution, the rates were only 1% at the Federal Reserve. Now they're moving to 5%, but we were doing 8% loans at that. Now we're doing 10.5%, 11%, 12% loans based upon the risk of the loan. So rising rate environment is good for Safe Harbor Financial because we not only earn more on our deposits, we then earn more on our loans. All right, I think those are all the questions that we have, but you can continue to ask questions or reach out to me, and I'm happy to get in touch with you.